The best investors don't chase the highest returns. They only take bets they can't lose. That sounds backwards, but it's exactly how Mohnish Pabrai built his fortune using a principle called Dhandho. And by the end of this video, you'll understand why playing not to lose is actually the fastest way to win. Dhandho is an ancient Gujarati business philosophy that translates to endeavors that create wealth. But the real genius isn't in what it tells you to do, it's in what it tells you not to do. The core principle is simple. Heads I win, tails I don't lose much. You're looking for investments where your downside is limited, but your upside is unlimited or very large. Think of it this way. Most people focus on how much they can make. Dhandho investors focus first on how much they can lose. They only take bets where the worst-case scenario is manageable, but the best-case scenario is extraordinary. It's not about finding investments with the highest potential returns. It's about finding investments with the highest potential returns relative to the risk you're actually taking. The mathematical beauty is in asymmetry. If you risk $1 to potentially make $10, you only need to be right 1 time out of 10 to break even. Be right twice and you're profitable. Be right 3 times and you're doing very well. But if you're risking $10 to make $1, you need to be right more than 90% of the time just to break even. One mistake wipes out years of gains. Let me show you how this works with real numbers. In the early 2000s, Pabrai bought Frontline, a Norwegian oil tanker company, at around $8 per share. Here's why it was a perfect Dhandho bet. The company owned tankers worth about $12 per share in scrap value. So even if the business completely failed, the ships themselves were worth 50% more than he paid. But the upside was enormous. Oil tanker rates were depressed, but if they normalized, the stock could easily triple or quadruple. Pabrai wasn't betting on tanker rates going up. He was buying $12 of assets for $8, with the bonus that if business improved, he'd make a fortune. The downside was capped at maybe 20 to 30% if he had to wait years and sell at scrap value. The upside was several 100% if tanker rates recovered. That's not a prediction, that's a mathematical edge. The stock eventually went to over $30. Heads he won big, tails he wouldn't have lost much. Here's what most people do wrong. They chase hot stocks, cryptocurrencies, or whatever's trending on social media. They're essentially betting $10 to make $1, but they think they're doing the opposite because they're focused on the potential percentage gains, not the probability-adjusted returns. They buy a stock at $50 because it might go to 100 without asking what happens if they're wrong. What if it goes to 25 or 10? They never calculated their actual downside, so they have no idea if the bet makes mathematical sense. The other mistake is diversification without discrimination. They think buying 30 different overpriced growth stocks is safer than buying 3 deeply undervalued companies with limited downside. It's not. You're just guaranteeing mediocre returns while still taking substantial risk. Here's your actionable step. Before you make any investment, write down 3 numbers: what you're paying, what you think it's worth in a bad scenario, and what you think it's worth in a good scenario. If the bad scenario means you lose more than 20 to 30%, don't make the bet. If the good scenario isn't at least double what you're paying, don't make the bet. You're not trying to predict the future. You're trying to find situations where the mathematics are in your favor, regardless of what happens. Dhandho isn't about being smarter than everyone else. It's about being more patient and more disciplined about the bets you choose to take. If this made you think differently about money, subscribe. One concept every week.